Hi, this is Terry. Let's work on Chapter 9. Chapter 9 is all about long-term assets, and by definition, long-term assets, the definition assets are resources used to generate income in future periods. What makes them long-term is these are assets that we're going to hold at least 1 year. So current assets are less than 1 year, one operating cycle. Long-term are greater than 1 year. Any of our assets that are subject to depreciation or subject to wear and tear then are depreciated over its useful life. And the idea here is that if you have a building and it's going to last 20 years, then you need to take part of that building each year that you use it into operation, use it in your operations, and expense part of it into the current time period. And that's all, again, based on the matching principle. Let me get rid of my little email here. There we go, the matching principle. Those assets that are subject to wear and tear would be like building and equipment, computers, that kind of thing. Items that are natural resources, then, we don't call it depreciation, we call it depletion. And then intangibles, which would be copyrights, patents, goodwill, those kind of items, items that do not have physical substance but are an asset to us, then what we do is we amortize that. So you would amortize in your car, you're going to amortize the cost of your car. You'll create an amortization table. All right. Let me get rid of my little red marks here. And the book value then is what it is worth to us. So for us to know what that book value is, we have a concept called accumulated depreciation. So if we're going to have cash, accounts receivable, et cetera, we go down the line and we come up with equipment, get down to that level where we are in property, plant, and equipment area. We'll have equipment less the accumulated depreciation. And the idea here is with the equipment, we always want to keep track of the historical cost. We don't want to lose that. So what we'll do is say equipment minus the accumulated depreciation, that's going to give us a net value. That's called our book value, net realizable value, carrying value, they're all the same thing. And what we'll do is when we first buy that piece of equipment, the accumulated depreciation is 0. Then every year when we expense a part of that asset, that goes into the accumulated depreciation. So we'll have something like depreciation expense for the equipment would be the debit, and then the credit would be to the accumulated depreciation equipment. So we'd have our debit and our credit values. We'll get into more of that here in a little bit when I go through the different methods. The next concept then is free cash flow. Again, let me get rid of my red marks here. Free cash flow, and that's the cash that remains after deducting the funds a company must commit to continue operations. That's a calculation that we can make. So the free cash flow is net cash from our operating activities minus our dividends minus our net purchases of asset. And again, it's just a means of keeping track of how well the company's doing. The next concept is capital versus revenue expenditure. And the idea here is a capital expenditure or revenue expenditure, we need to know how are we going to put this onto our books. So a capital expenditure would be any item that is going to be on our books for more than 1 year. A revenue expenditure is the same thing as saying an expense. So we're going to put a building onto our books. We're going to capitalize it. And that concept means we're going to put it on the books as an asset and then depreciate it over time. If we get a telephone bill, that's going to be a revenue expenditure because we're going to just record it as telephone expense in the current time period. Sometimes what we'll do because of an amount not being material, which is one of our accounting conventions, if it's not a material amount, we may have something that may last 10 years, such as a pencil sharpener. We take a pencil sharpener, mount it to the wall, well, it's going to last more than 10 years, and therefore, in the normal scheme, we would capitalize it and depreciate it. But since it's such a small amount, what we would do is just expense it into the current time period because the amount is not material. Remember that materiality, the concept is an amount is material if the investor knows it and makes a different decision. So the question is, well, what amount is material? Is $50,000 material? Get back to my spot here. There we go. Is an amount material? Well, $50,000 to a mom and pop groceries is probably a material amount, but a $50,000 to Microsoft it would cost them more to go find that mistake than the mistake itself. So it costs them more than $50,000 to find it. So they wouldn't even bother. So a revenue expenditure, we can take something that is going to last more than 1 year and expense it because it's not material. The next concept is addition, betterments, extraordinary repairs. An addition would be when we add physical size to a building. So we would debit the building account and credit cash or notes payable, however we're going to pay for it. When we add on to that building, then we would debit the building account for the addition. The addition would add the physical size. A betterment then does not add the physical size, but makes the value of the building more valuable. Probably the easiest or best example is when you add in an elevator. It doesn't increase the size of your building, but your building is more valuable because it's there. An extraordinary repair is a little different. That let's say that we have a piece of equipment, and let's work with just some real simple numbers. We got a piece of equipment that's 10, and the accumulated depreciation on it is 7. So we have a debit balance in the equipment. Accumulated depreciation is a contra account, which we should have seen up here, right? Accumulated depreciation is a contra account. And therefore, at this point, the book value is 3. Well, let's say that equipment has some kind of motor in it and that it's worth us fixing. Example I give in the classroom is like a cement truck. If the motor goes out on the cement truck, the motor is such an insignificant part because it's all the back end of the cement truck that's so valuable that it's worth just putting in another motor. So what we would do is that we would take the value, let's say it cost us $3 to put a motor in there, then we would back off, so we would debit accumulated depreciation $3, and then we would credit cash for $3. At this point now, our accumulated depreciation has gone from 7 down to 4, so now our book value is 6. So where before our book value, 10 minus 7, was our book value was 3, now 10 minus 4, our book value becomes 6. So this is the concept of an extraordinary repair. The item to remember is, the thing to remember is, once you do an extraordinary repair, now you have to recalculate what the depreciation expense is going to be because you probably have a new salvage value and you have a new useful life. The next item then, land is never depreciated. So we never have a depreciation expense for land. What does come into play is what's the cost of the land. So the cost of the land is going to be anything such as the cash that we paid for the land. Then if we have any lawyer's fees or filing fees, that goes into the cost of the land. If we have to remove any existing, small buildings, etc., to clear the land off to get it in usable shape. If we have to do any grading, bringing heavy machinery in there and change the contour of it, or if we have to put any sewage in or whatever it takes to get the land in usable condition, then collectively all of these costs are debited to the land account, and that becomes the new value of the land. So the land is not just the cash we paid for it, it's the cash and all the other fees and expenses that we incurred to get it into a usable condition. Land improvements then are different. They are subject to wear and tear. They are depreciated. Land improvements is an actual ledger account, just like land is an account, land improvements is an account. Land improvements would be things like lights in the drive, or in the parking lot, paving the parking lot, putting up signs, any of those kind of issues. So anything you do to improve the land, to make it usable, sidewalks, lighting, paving, signs, etc., goes into the land improvement accounts, and then those are depreciated. The next concept here is, what do you do when you have a group purchase? So I threw in a couple little numbers here real quick. What if you're going to go out and you're going to buy land in a building and somebody says that's $100,000, that's what we're willing to take? And you say, okay, how much for the land and how much for the building? And they're going to look at you like, well, you're nuts. It's $100,000. Do you want it or not? Well, if we take the fair market value of the building here and see that it's $90 and the fair market value of the land's $30,000, we have to come up with some way of knowing how to record. And it's very simple that we take the total of that, which is $120,000 fair market value. Then we have 9/12 for the building and 3/12 for the land. So we would put into the building account 3/4 or $75,000 for the building. In the land account, we would put in $25,000, and then we would credit cash for the $100,000 that we paid. This concept is called group purchases or apportionment. All right, the next one. This is our different methods for depreciation, and we're really just going to work with three here and then a tax version of this. The general formula is cost minus salvage divided by useful life. So in this particular situation, we're going to work with straight line first. Straight line method, let's say that we had a $120,000 vehicle, $20,000 salvage, and it's going to last for 5 years. Well, according to our formula, we take $120,000, we subtract $20,000 salvage, which is our estimate what the vehicle is going to be worth at the end of its useful life. We divide it by 5, so we get $100,000 divided by 5, and under straight line method then we'll depreciate $20,000 per year. So we would record depreciation expense of $20,000 and a credit to accumulated depreciation for $20,000. Couple things to remember is that if you buy this and your fiscal year ends, if you buy this, let's say you buy this July 1st and your fiscal year ends December 31st, then you have to remember in that first year to take half of that. So you would want to take 6/12 of that because you only owned it for 6 months before your fiscal year end. You wouldn't be able to take a whole year's worth of depreciation. Then in years 2, 3, 4, and 5, you'd take a whole year. In the 6th year, you would take that last half, and then it would be fully depreciated. The double declining method is a little bit different. And the double declining method says what you want to do is take twice the straight line percentage. So if we're going to have 100% and we're going to depreciate this over 5 years, then that's 20% a year. The double declining then says take that times 2, so we're going to take 40%. This method's a little different. The double declining is a little different, that we don't use the cost minus salvage, we just use the cost. So we'll say $120,000 times 40% is going to be $48,000 is how much we depreciate in the first year. Then in the next year, we would take $120,000 minus the $48,000 that we've already depreciated, and then whatever that number is times 40%, and that's going to give us the amount that we depreciate for that year. And whatever that amount is, then we take 120,000 minus the 48 minus whatever number this was, so minus that question mark, then take that times 40%, and that will give us yet the next year. With this method, then you go down to the salvage value. So even though in that fourth or fifth year you may calculate a number that's larger than the salvage is the amount you should depreciate, you would never depreciate below the salvage value. Again, the key issue here is to come up with this percentage, and then to remember to start with a full amount, not cost minus salvage. The third method is the production method, and here we would say cost minus salvage, so $120,000 minus the salvage of 20,000 divided by, and then the useful life is expressed in miles, so 200,000 miles. So we'd have 100,000 divided by 200,000, or in other words, 50 cents per mile. Then you would just look and see how many miles you drove in any given year. So if you drove, I don't know, let's say you drove 50,000 miles the first year, well then your depreciation would be 50,000 times 0.5 or 50 cents. So you'd have $25,000 in depreciation expense. All right. The next item then is acres and makers. And this started out as part of the started out in 1980 and then was modified in the Tax Reform Act of 1986. And this was all part of Reaganomics. Prior to 1986, all depreciation was straight line. Then in 80 to 86, they came up with the concept of acres, accelerated cost recovery system. And the idea here was, let's say that you had an asset that had a 12-year life. Well, what you were able to do was to depreciate this over 5 years. And the idea was that if you could take and get that huge depreciation expense, then you'd have a huge expense and depreciation doesn't use cash. Then our economy, our businesses within our economy, would have more cash to invest and put more people back to work. This was a time period where we had just huge, high inflation, lots of people out of work. There was, the whole building industry, there was nothing being built, and nobody was buying cars because they just couldn't afford the interest rates. Well, part of Reaganomics then was to come back and say, all right, let's let businesses accelerate their depreciation over 5 years. There's a lot of nuances to it. It actually took 6 years because there's a half-year convention and all these other things. But you simply looked up in an acres table what percentage you could depreciate. Then the only way that you could get depreciation in the 6th year was to go out and buy new equipment. Well, the idea there was that to go out and buy new equipment, somebody had to make it. If somebody made it, then there had to be more jobs. If there was more jobs, then there was payroll taxes going to the Treasury. Those people now get a paycheck, so then they go out and buy groceries, so now they're paying sales tax. Then there had to be people at the grocery store putting food on the shelves, so now there's more payroll tax, and it was, just a trickle-down effect that $1 just over and over and over would generate more taxes for the government. It was very, very successful and an absolutely brilliant idea. The problem was it was a little bit too brilliant, and so what they did was in 1986 they modified it, so the modified accelerated cost recovery system, and then they switched the useful life that you would go into tables and look up, a computer belongs here, a light truck belongs there, furniture and fixtures belong there. So you'd look these up in the table, and what was a 5-year life became a 7-year life. So it's still a good deal. It just wasn't as good of a deal. The difference then between using straight line method, double declining, and production method, these concepts here are for tax purposes. So the difference between financial accounting and for tax accounting, then that becomes your deferred taxes. So that's a whole nother topic we want to stay away from. It's a whole lesson unto itself, and would be something that you would have to study in great depth if you were going to go become a CPA. We're not going to dig that deep. All right. The next item then, what happens if we get rid of an asset? We sell it. Your book doesn't go into great detail, so I'm just going to give you a quick little example if my computer will behave here. Let's say that you have a piece of equipment, and again, let's use easy numbers. So we've got $100 piece of equipment, and let's say the accumulated depreciation on that is 80. So right now the book value to us is 20. And somebody turns around and says, well, I'll give you cash of 30. So that means that the fair market value is 30. It just means that we depreciated a little faster than what we should have. So when we take this off the books, we'll need a debit to accumulated depreciation of 80. We'll need a credit to the equipment for 100. And now we know that debits and credits have to equal, so therefore we have a gain on the sale of the equipment. That gain then has to go into our income statement and be taxed as if it's a revenue. We just can't call it a revenue because revenues are from operating our business. This is a side event going on of selling a piece of equipment. Selling the equipment's not what we're in business for. We're selling a product. We're selling, speakers, telephones, whatever it is we're selling, and then when we sell off a piece of equipment, we have a gain. So therefore, that gain has to go into our income statement and be taxed. It gets a little more involved when you talk about, instead of just selling it for cash or throwing it away and recording a loss, what happens when you buy another piece of equipment. So you sell the old equipment for new equipment. Then the question is it for a similar or dissimilar asset? So are you buying one computer and selling an old computer, buying a new one, or are you selling a truck and buying a computer? And so it matters whether it's similar or dissimilar in nature, and then whether it's for financial or tax purposes. That's beyond the scope of the book, but the push of it is whether or not you recognize a gain or a loss, or do you change the dollar value of your new asset and either increase it or decrease it to absorb that gain. So again, it's out there. You should know that it exists, but it's not something that we're going to deal with. And then the last two items here, goodwill, trademarks, copyrights, patents, franchise, leasehold, software. Those are all items you should read in your book, but these are all examples of our intangibles. And the idea here is they're assets and that we need to amortize them over time. So we need to expense them. Goodwill, trademarks would be like the golden arches at McDonald's, that idea, or Coca-Cola's trademark, etc. Goodwill is when you're willing to pay more for an asset than what it's worth. So if you buy out a company and you're willing to pay more because they're your competition, so you're just trying to get rid of your competition, you'd be willing to pay more than the fair market value of the assets. So that excess goes into goodwill and then is expensed over time. Each of these have different rules and regulations. How long is the patent worth? Copyright is, I believe, is something like the life of the person that wrote the music plus 40 years. Medical people have to, they have 7 years to recoup their money. So if you go out and buy, Viagra, then after 7 years, anybody can make Viagra or Valium or any of the medicines out there. After 7 years, anybody can make them. So the last item here then is research and development, and that is the one huge exception The matching principle says that you cannot have expense unless you have a revenue to match it to. So when you go out and buy raw materials and then you move them into work in process, into a factory, and then to the finished goods warehouse, at all this point in time, the fact that you've spent money on those items, they are not expenses, they're just costs. They're inventoriable costs. And it doesn't become an expense until you sell that item, and then that expense becomes cost of goods sold. So the matching principle says you can't have an expense if you can't match it against a revenue. Well, research and development, so much of the money that's spent on it never becomes a product that's sold. So APB opinion number 1 says research and development is the exception to the rule, therefore R&D costs are expensed in the time period which they occur, which absolutely violates all of the normal accounting, but again, this is an exception to the rule. All right, long chapter. Hope this was valuable.